The price-to-earnings ratio, PE ratio, is a fundamental financial metric used by investors to evaluate a company's valuation by comparing its market price to its earnings. It is calculated by dividing the market price per share by the earnings per share, EPS. The market price per share represents the current trading price of the stock, while the EPS reflects the company's profitability, calculated as net income divided by the number of outstanding shares. The PE ratio helps investors understand how much they are paying for each unit of a company's earnings. This ratio is particularly useful for assessing growth and value opportunities. A high PE ratio may indicate that investors expect strong future growth from the company, but it can also suggest that the stock is overvalued. On the other hand, a low PE ratio may imply undervaluation, making it an attractive buy, or it might reflect challenges in the company's performance or outlook. To interpret the PE ratio effectively, it is essential to compare it to the industry average, historical ratios, and the overall market trend. The Fairvalue Calculator at fairvaluecalculator.com makes it easy to calculate the PE ratio. By entering the market price per share, which can be found on financial platforms like Yahoo Finance, and the EPS, which is available in company reports or financial summaries, you can instantly see the ratio. This allows for quick and efficient analysis without needing to do manual calculations. Using the PE ratio is crucial for identifying undervalued stocks or spotting growth opportunities. For example, in times of market volatility, fundamentally strong companies may trade at lower PE ratios, offering excellent buying opportunities for long-term investors. By regularly analyzing PE ratios with the help of tools like the Fairvalue Calculator, investors can make well-informed decisions and enhance their investment strategies systematically.